The good old bears over at TS Lombard are back with another bear piece. So let's see what a Sing a Simple Song bear piece today is. Looks like it has to do with bonds. They say the economy is slowing, inflation is going to rise. Well, I dispute that. And financial conditions are going to tighten. Okay, well, this could be a problem. I'll remind you for a moment, financial conditions are not just a measure of stock prices. So high stock prices would mean lower financial conditions. Lower stock prices would mean tighter financial conditions. But this also has to do with lending. So if banks start restraining lending, then we might end up seeing an economic slowdown because of the lack of access that companies have to credit. Okay, so before liberation, with the Treasury to sell around $1 trillion in new debt, this simple song is hot fun in the summertime. By then, the rest of the world could look even worse. Global boost from U.S. exports in Q1 are done. Okay, this is what we've seen of it a lot of the earnings in Q1. This big boost in exports and imports in Q1. U.S. net exports were big enough to be the 18th largest economy. That's interesting. That's the net imports, rather. Bank credit, more critically, has begun to slow. Okay, this is where things get poopy. And market pricing discourages extensions moving forward, except to the government. Extensions of debt, basically, so repayment terms. Banks will lend to Treasury. Okay, this is Strategic Loan Reserve, that's fine. While waiting for Trump's Fed to get underway, Powell's closing chorus remains the same. Data are the message. So while we wait to receive one, and until then keep the short end inverted to hold in reserves, talking about probably the 3-10s, 3-month 10. Anyway, so it is a muddle through or stuck in the mud or something else in the economy. Is it? Okay, got it. This is a little weird wording we've got here. Muddling through is an illusion. The underlying process have been let loose and are ongoing with the intention of changing the mean, so the averages, to keep one from... Okay, very fancy, like some high-level, college-level writing crap here. Let's try to get to some actual bottom lines. Growth will be slower than consensus in Q3. Inflation higher and still higher in the coming years. I'm not that bearish on inflation. How much higher depends on how much the Trump Fed allows global capital flows to dictate the domestic economic outcome. My bet is not much. Travel has always been one of the best early indicators of a turn in the economy because it is an expensive, most easily deferred. Because it is expensive and most easily deferred. So in other words, they're telling you that travel often gets cut early and it can be a leading indicator of economic pain. Here is airplane traffic, which is negative year over year and historically is always a bad sign for growth. It actually just went negative too, which is quite interesting. You see that right here. We just went negative in May of 2025. So I'll keep an eye for that. Mind you, the volatility on the 7-day moving average is pretty high, but you want to look at that 90-day moving average, and that 90-day moving average has really been collapsing since 2024. That's quite interesting. Growth in bank lending has begun to slow, in line with the return of a negative curve from 3-month to 3-year yields. Fine. So now you're just picking yield curves. Fine. Growth in loans and leases also dovetails with M2 money growth, which is now also about to slow. See, now this is interesting because what you really have so far is you have the TS Lombard saying, look, Q1 was great. We had a bigly boost and it was sexy. Okay, now they're saying bank lending growth slowing, travel slowing, M2 about to slow, right? So they're really setting up for a creme de la creme explosion here, it sounds like. Well, let's see what they say. Inverted curve at the short end begins to show slow loan growth. Fine. In the coming quarter, the Treasury is going to raise $1 trillion of new net cash, $560 billion to finance the deficit, and the rest goes back into the Treasury general account. The cost is going to be higher, notably at the long end. Real yields, using TIPS as a measure, are higher, and so is the term premium, and both began to rise before Liberation Day. With higher term premium, the break-even inflation rate is lower for the purpose of this chart. Okay, that's fine, that's fine, that's fine. Everything Trump is doing, including the future course of Treasury financing needs, and who will be running the Fed, raises the long-term risk. So Trump is raising basically long-term costs, long-term term premium, fine. Odds are the high watermark for term premium this cycle is yet to come. Okay, so they also argue, these bears, these dirty bears, they also argue at the same time, term premium, so basically, we'll just call it total, term premium / total yield will rise on bonds, which is bad news for bonds. Another sign that financial conditions have tightened is that the 2, 5, 10 butterfly is more negative. Going back to the banks, looking at, I think these are high quality loan asset levels and loan loss allowances as a percent of loans outstanding. The higher IQLA is in line with higher allowances. I'm not sure about that. I have to look at these as approximate total assets. This I'm less sure about. All right, small banks holding higher. Okay, we got to look this up. HQLA banking. It is high quality liquid assets. Oh, I was so close. Okay, got it. So high quality liquid assets as a percentage of loan losses. Oh, that's interesting. Large U.S. banks holding higher high quality liquid assets in line with greater loan loss reserve. So in other words, we want more cash to offset, potentially higher losses. It's a little nominal there. Here we have more losses than we have liquid assets, not uncommon for small banks. Inverted curve at the small end is a strong incentive for banks to hold liquid assets rather than lend. In sum, growth is slowing heading into Q3. Treasuries are ramping up and the real costs are higher. Okay. All of which adds to the potential for a difficult Q3 as the economy will begin to see how much firms can pass tariffs on to retail. I think that'll be nearly zero. The more that it can, the more inflation goes up. The more that it cannot, payrolls decline. See, and I think that's actually a very reasonable conclusion, that line right there. The more of the tariff prices we pass on, the more inflation we get, which delays rate cuts. The more we can't pass on, the more earnings go down, the worse it looks for corporate earnings, and the more payrolls go down. Given the distortion to spending to avoid tariffs, employment will be a better, more contemporaneous gauge of the economy than top-line leading spending numbers. So I agree with this. I'm of the mindset that unemployment may skyrocket by year end because of the lack of pricing power corporates have. My take. Given the distortion to spending to avoid tariffs, employment will be a better, more contemporaneous. Okay, as far as the Fed, they will wait for the numbers to speak. Well, of course, this is why we call him Too Late Powell. Thanks, Trump, for the nickname. Okay, financial conditions are tighter than they were when the year began. Yes, that's true. And having lower financing costs by 100 basis points. That's ironic, actually. This is a big irony, which is worth paying attention to. We already cut rates by 100 basis points at the end of last year. And now things are actually worse. So data is their guidance. Data is their guiding guidance. The timing of the first cut in 2025 will depend on when or if the unemployment rate jumps over 4.5%. Yep, totally agree. And it's a shock that happens fast. So I sort of, I don't agree with all that T.S. Lombard says, but I think this is a very good outline of the current bear case. That's what we could call it, the current bear case. The current bear case is basically, look, Q1 was great because we had the pull forward of tariffs. Q2 looks good because we're importing less. Q3 is when the poopy starts hitting the fan, assuming we don't yet have any deals. Given that we've only had one deal with a trade surplus nation, things aren't looking great for actually getting deals. Now, there's a lot of hopium, I'm hopeful too, that we're gonna get great news on these Chinese trade talks. But so far, things are dead quiet on where we stand with these trade talks, other than, Lutnick saying that, talks are going well, but it's going to be a long day. Okay, so again, maybe NVIDIA will get a boost because we'll get a resumption of the, the H20 chips or whatever for China, the Chinese designated chips, basically the software dialed. Think about those chips as kind of like, and I'm oversimplifying here, but it's kind of like Tesla selling you the Tesla car, but then they disable the seat heaters unless you pay for the software upgrade. So it's kind of like the technology's there. You just need to unlock the software. I'm oversimplifying because I'm sure there are a few fewer transistors on the actual boards in NVIDIA's case. But the point is, like, yeah, there could be some upside here for NVIDIA on this Chinese trade talk and certain companies, including Tesla, mind you, because of the exports of rare earths, if we can unlock some of that again. But until then, or I mean, even if we get that, sort of like despite the assumption that we're going to get those things, we don't have a broader trade deal on toys or furniture, clothing. These are all things that are impactful to companies that are already suffering. I mean, look at, for example, a Nike stock. We jump into Nike. We are off bottoms for Nike, but they have margin problems as well as growth problems, and tariffs hurt them even more. So it's important to see how things evolve here. China, by the way, or Tesla, by the way, just broke its 318 line. Look at this. This is the line we've been talking about in the Alpha report. Very important to watch. We just bounced on 318. That's actually quite bullish. Let's see if it can hold that. But look at that. Broke through 318, came back literally to test it. You know what that is right here? That right there? That's an advertisement for the Alpha report. It's like, see? If you were part of the Alpha membership, you would have known not to speculate on CoreWeave today because the momentum's over. Instead, you would have been watching this line. It's exactly what we talked about in the Alpha report this morning. Get it at mekevin.com. Circles over as well. So here, Nomura Research, we've got, okay, Nomura Research. Let's get weird and unpack my rationale for the path of U.S. equities. Up, then down. Okay, let's see what their thesis is on why we're going up, then down. The Trump caller has both simultaneously contributed to recent compression and realized volatility. Basically, things are slowly melting up because volatility is going down. Yet also now in real time is building the risk for wingier outcomes in equities. Okay, this would be like left and right tails basically. So, okay, fine. As the assumptions of the caller therein create lazy conditioning with regards to Trump selling upside call, Trump activating downside put, which can then get stopped through with a modification in anticipated behavior. Fine. Taco on the way out. Or on the way up. Trump always chickens out on the way up. That is, yesterday's Trump gives U.S. negotiators room to lift export controls. Right. Okay, so in other words, markets right now, like in English, markets going up because taco since April 9. So basically, Trump equals baddie April 2 to 9. Trump equals taco since April 9. Okay, all right, okay. As I've been saying for a while now, however, there's already been a greater risk of a right tail equities move at this juncture because nobody owned it. This is basically like institutions buying in, so like an explosion to the upside. So this is explosion to upside as people are under allocated. With so much embedded macro bear economic skepticism, hence weak exposure, fine. Grossly uncaptured V-shaped recovery, thanks to taco. So now the right tail holds, fine, instead of seeing breadth increasing with the S&P within 2% of all-time highs. Fine. Now, even the unloved parts of the market are rallying too. Okay. Even trash is now going up because people missed the V-shaped rapid recovery thanks to taco. I'm just translating this into English because this person writes like he's a computer, not talking to another human, but talking to another computer. Year-to-date equity performance, but the past week has shown significant unwind and degrossing of themes. Okay, get some charts. And something else to ponder. Notionally speaking, by an order of magnitudes, the single most consequential flow from Trump's trade policy shocks is the perverse dynamic where corporate uncertainty has instead led to equities being bullish via repurchase authorizations. Okay, yes, this is also true. So tariffs should be bad for corporates. But corporates, buy back everything, baby. So this is basically a way of saying corporations are propping up their own stocks through massive buyback authorizations, which to some extent is true. And corporates are typically bad at timing when to buy back. Like they tend to buy back at highs and higher levels rather than like in recessionary times. Not uncommon. Okay? That's a very human problem. So here we are now. We've rallied up into that location where dealers are actually short index calls from right tail hedgers and call skew I've been noting, blah, 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 upside. This short upside gamma for dealers could act as an accelerant flow, which pushes the market higher. More catch-up flow. Okay, fine. People trying to chase market will lead it higher thanks to market dynamics. Oversimplifying gamma. Plenty of dealers short call, which could act as an accelerant. Fine. All right. AUM 99.5. Okay, fine. Let's see here. What do we have here? And for what it's worth, 3 mil and vol. That's fine. Rollout. Okay. That's fine. Broad theme of recent market tours that the vast majority of entities remain psychologically embedded in the macro bear camp. Hence the theme of underpositioning equals undercapturing the equity rally. Instead, most ask when crash. Right. Okay. Basically, many got bearish in April and are still offsides. Equals stonks can keep going. Sticks. Fine. But like I always like to remind, in order to have the conditions for crash, you first need excess positioning, speculative froth, a steep skew, and typically accelerated flows. Fine. So in other words, up first, then down. As we do, then ultimately see by midsummer that labor is indeed cooling and layoffs pick up. There it is. Okay. So this is the same bear thesis that has been prevalent since July of last year. Same bear concern as July of last year. Layoffs cometh. This is where the persistent U.S. economic miracle, led by consumers' ability to digest headwind after headwind, finally cracks, and they can no longer absorb the pricing pressures which corporations have previously been successful in passing through by continuing to grow EPS. In other words, the consumer is effed. So layoffs, then consumer pain. That's when you have recession, okay? At that point, labor finally succumbs and the jig is up. We'll get our volatility event just like last year's August 2nd to 5th when we thought for the first time that labor did indeed break. Right. The fake labor break of last year, Japanese carry trade. Okay? So the completely unrelated in macro sensing S&P and a long fine float around my desk. Fine. Let's see. Autopilot, Powell. Okay. I hypothetically then see today as a ragingly finger in the air 0 date. And 50 days is something into early August where the projected downturn would begin. That event risk between now and then, all of the VIX upside seasonality and awful liquidity of peak summer, and time for labor data to cool into something more ominous between now and then. Okay, basically, the clock is ticking. 50 days to hell, where seasonality and illiquidity crush the market and labor market implodes. Okay. And that's that. All right. That's very interesting. So this actually kind of like adds to the previous bear piece. And look at that. Whoever hit the sell button just created an intraday V shape as Tesla now has regained 318.82. Barely though. Barely retesting 318.82 right now. Hey, quick reminder, if you want to earn a 5% yield plus all of the upside in my real estate startup, we are offering a non-accredited investor round where we will pay you a 5% yield Plus, you get all of the upside in the stock when your stock converts in the future. It gives you an opportunity to diversify away from rich stock market valuations, diversify away from most tariff risk, diversify away from the craziness of the treasuries market, especially with these Moody's downgrades. You diversify into fixer-upper real estate, which is what I believe I do best. This is my baby. I call it my little Berkshire Hathaway. Now, maybe I'm biased, but I've got over $5 million of my own money invested into this business, and I'm so excited for what I think we're going to be able to do with this business over not just the next years, but the next decades. So if you want to invest in my real estate startup, go to househack.com and know that I will do everything for this business in my power to make sure we can do the absolute best that we can. Make sure to read the solicitations and disclosures on the HouseHack website, because there is risk with every investment.